Extension Economist at Oklahoma State University, and I'd like to welcome everybody to our discussion of benchmarks for agriculture. This is a topic that I enjoy discussing when I have a live audience, as you can see kind of light bulbs going off and audiences thinking about their own operation, how they may stack up compared to others. Benchmarking is a tool that can benefit producers and lenders in better understanding a farm's financial position as well as its performance over time. And I think that understanding leads to better ideas for improvement and control of expenses. Looking at the farm's financial situation from a different angles, profitability of course, but also with a closer look at expenses by type can be insightful. Looking at cash flow, leverage, repayment capacity can also come into play. Benchmarking can also involve not only financial but also production measures. Monitoring performance provides insights both within the year and over time that are useful to producers who are active managers. Analysis and comparisons are particularly important in downturns so that troubleshooting can be done effectively and efficiently. In addition to talking about the value of benchmarking today, I'll share some data for comparison on cow-calf production, wheat, and family living expenses. I'll also talk briefly about available tools to help in benchmarking efforts. This chart from the USDA's Economic Research Service notes an expected improvement in net cash farm income overall for 2017 compared to the last couple of years. But what I've heard with respect to grain outlook doesn't suggest a huge uptick for crop producers in the near future. So we know ag in general has been facing more financial stress in recent years. And income at the state level, and especially farm level, is much more variable than what we observe on average at the national level. There's a lot of uncertainty about trade, which is very important to ag producers, given the volume of production that's exported. So from a management perspective, introspection through things like benchmarking is often beneficial. So that means having a well-developed record system along with summaries to help producers along the path to achieving their goals. Monitoring progress over time towards goals such as paying down debt can help foster discipline in spending. Watching to see that costs such as repairs or veterinary expenses aren't steadily increasing may signal that proactive measures are working. Producers who develop annual performance measures in a standardized way and study them regularly are better positioned to take advantages of opportunities and also better prepared to deal with adversity. Comparisons to averages or peers or even global data can be helpful to understand the business competitiveness and sustainability. Certainly everyone would like to be above average. Average in agriculture is often break even, just a minimum to survive, but not a level at which anyone can thrive. The business can benefit from knowing how it differs from those who are better off and those who are worse off financially. Are they getting better production, for instance, a larger calf crop percentage? Are they getting a better price? What research consistently shows is that higher profit producers are generally good at controlling cost. So comparisons of cost of production can help focus on significant costs as well as cost differences. I often describe financial analysis as detective work. So once a manager is informed, then they're positioned to take appropriate management strategies. Kansas Farm Management Association collects data from members of its associations and summarizes them annually. This chart represents about 75 farms with cows. The 2016 cost of production for producers is sorted from high to low in terms of profitability, with the three bars representing each of these thirds. The highest profitability group is at the left, and the lowest is at the right. While it isn't always the case that larger farms are the most profitable, in this instance the average herd size is 263 cows for the most profitable third, 120 for the mid-third, and 97 for the lowest third. The most notable difference between the top third profitability groups, so those two bars at the left compared to the bar at the right, is the expenditure on pasture and feed. So if you look at the blue and the orange at the bottom, you'll see that there's about $150 difference in the cost of pasture and feed. So meeting the cow's nutritional needs explains the majority of the difference in the cost. Knowing that might drive the producer in the low profitability group to the extension office for advice on better pasture management. It might lead them to think about stocking rate or what they're paying in rent. It might also cause them to ponder whether their fat-happy cows could be a bit thinner and still be happy and efficient. So you can also see there's some differences in depreciation and interest on investment. So those are near the top of the charts. This likely comes from an investment in machinery and equipment that's divided over fewer cows by that low profitability group. I should have mentioned earlier, if you have any questions, type in the chat box at the right, and I'll be happy to try to answer any questions that we have when we go along. So this was 2016 data, so about $1,000 per cow, total cost, cash as well as fixed and overhead costs for the low-cost producers compared to about $1,400 for the high-cost producers. KFMA also publishes multi-year averages, so you can see the differences that I described aren't just a result of conditions in 2016. Here the average starts with 2014, a year with record high prices and profitability. So each of the bars for the 2014 to 2016 period average about $300 per cow than those that we just looked at for 2016. So clearly some belt tightening has taken place. Again, most of the differences in cost between the least profitable third of producers at the right compared to the other producers is explained by the cow feeding costs, cow's nutrition cost, and machinery related expenses. There's another source for benchmark data that's called FinBin. Data is summarized a bit differently compared to the Kansas Farm Management Association data. It does tend to represent mostly farms in Minnesota with additional contributions from North Dakota and some other Midwestern states. For this report for beef cow enterprises for 2016, you can see at the top left there's 235 enterprises with data sorted into deciles. So they're sorted by tenths, and you can read them from left to right. The median is reported here at the left. So we won't look at all the numbers or drill down into detail today, but you can easily recreate this report for this enterprise as well as different kinds of crops and so on at the FinBin website. I'll point out just a couple of items. So here the total expense on average is $626, significantly lower than we saw in the Kansas data. Again, we can look at patterns. We'll just look at the feed expense line quickly, and so you can see for the highest 10% cost, the value is $660 compared to only $200 for the low cost decile. And this database feed includes pasture as well as raised and purchased feed. And again, we see the role that the feed expenses play in explaining the difference between the most and least expensive operations. That's a $460 difference per cow in the feed expense from high to low. If we look at the net return to labor and management down near the bottom, you'll note a $1,000 swing from a loss of $809 per cow to a profit of $234 per cow. So FinBin's another resource for benchmarking data. Production benchmarks are somewhat hard to come by, but again are useful to discuss and ponder. I've worked with producers who didn't realize that a 90% calf crop was very achievable. And certainly a producer who wants to be sustainable has to be aware of norms and how they are achieved. For crops, USDA's National Ag Statistics Service provides county average yields, and we use those as references, for instance, in our budget tools. For livestock, there's no similar statistic. So in this chart at the left, I've uh, highlighted some data from what's called the SPA database, Standardized Performance Analysis. Data collected largely by Stan Beavers with Texas AgriLife Extension in Vernon, Texas. Since Stan's retired, there's no new data, but it does show that reproduction losses are primarily due to cows not calving, and then other data indicates that the majority of these losses are due to cows never becoming pregnant in the first place. So we have an 88% calving percent, a 4% death loss, leading to an 83% weaning rate. On the other side, I've reported some data from North Dakota's CHAPS database showing much higher realized calving percentages attributable to the high pregnancy percent ratios, and also lower calf death losses, leading to an average of 91% weaning percent over an 8-year period. So I promised some wheat data. So here's a wheat cost of production chart that highlights data from two sources, Kansas Farm Management Association at the left and USDA data at the right. The USDA data is based on what's called the Prairie Gateway, which includes most of Kansas, Texas, and western Oklahoma. So KFMA data is again from the producers who participate in their farm management associations and contribute their financial data. USDA's data comes from a survey, Agricultural Resource Management Survey, and we appreciate the producers who fill out those surveys as they clearly provide valuable research and extension material. So I've attempted to align the different labels and categories used by the two different sources to compare them. And in fact, the results for the average total cost shown at the top are remarkably similar, with USDA about $10 on average higher. There's some differences in fertilizer and lime, so about $15 difference between KFMA and USDA data, as well as a bit of difference in the chemicals, so the herbicides and insecticides. We see about a $10, $20 difference there. Depreciation and land charges at the top also shows some differences. So part of the difference may be in my grouping, and some may be methodology. For instance, where KFMA uses cash rents plus an estimate of share rent, USDA uses an opportunity cost value for its land. So this points out that you'll want to understand the data collection and summarization processes in whatever benchmark data you choose for comparison. I also mentioned family living expenses as something that you might want to track. Averages mask a lot of variability in all the data that I presented thus far, but they do tell part of the story. So here's the average family living expenses over time from the KFMA data. In this case, you can see that during good times, so for instance from 2008 up to 2014, we see family living expenses increasing. It's probably not surprising that maintenance may have been deferred on the house, or the family may keep better rein on expenses in general during lean times. But I'll point out that from 2012 to 2014, there is a noticeable difference in house upkeep and repairs, shown in the gold. And so we saw probably some catch up during those good times. It's also clear that during the downturn, family living expenses don't come down perhaps as quickly. Interestingly, it's not clear that personal recreational expenses shown in the blue have come down any more quickly than any other expense categories. So maybe once you have the boat or RV, I guess you keep going to the lake or you keep traveling. So records are the foundation for individual benchmarking, whether for internal use or comparisons. A good cash record keeping system is complemented by balance sheet, inventories, and production records. There are a variety of tools available then to go the next step in summarizing data. You can, of course, start with paper, but software tools make the job a lot easier and more meaningful in my view. I'll quickly highlight a few. So we're adding new standalone tools for financial statements on our eFarm Management website. Iowa State's Ag Decision Maker, K-State's Ag Manager.info, and the University of Illinois' FarmDoc sites also have a variety of similar standalone financial tools. I encourage people to explore them to see what best suits their needs. The Cadillac version is FinPack from the University of Minnesota, which generates the data for FinBin that I showed earlier. The financial statements within it are integrated, and you can develop long-term financial plans, evaluate alternative enterprises, adding and subtracting different components of a farm plan to evaluate alternatives. We're interested in developing a user group within the state to begin to develop benchmark data for Oklahoma, so we don't have to rely so much on insights from other states or periodic national data. Whether you're a producer, a consultant, a lender, tax preparer, or accountant, we'd like to hear from you if you're interested in collaborating. So we do offer, we have a website that allows you to build your own account book by printing individual pages. We also have a PDF online of what's referred to as the old Blue Book, the Family Farm Account Book. So for those who want to have hand record systems, those are available. But I'm a big proponent of software use and computerized records. I think that anyone who wants to sort and summarize records in meaningful ways needs to adopt software and invest some time in using it. We have lots of resources on how to get started with Quicken, an inexpensive, user-friendly personal finance tool that can be adapted for farming. And you can see those publications, videos, and more on our website, or contact your local extension educator ag for hands-on workshops in the local community. QuickBooks is also certainly a great tool, and so I don't try to convert anybody who's currently using that to Quicken, but offer Quicken as an alternative for people who are wanting to step up from the shoebox, for instance. We don't offer or develop production record software, but we do publish periodic current reports that describe the features of commercial tools, and so you can see those listed here. They're available on OSU's fact sheet website. I'd also mention that NCBA provides a great pocket record book for cow-calf producers, and those can be ordered online through NCBA. Even though I'm a proponent of software use, low-tech has its place. If nothing else, it's useful to start with looking at a couple of years of tax returns side by side. For producers who want a worksheet to help them summarize some statistics, AgriCon 238, a Farm and Ranch Financial Trends worksheet, provides some guidance. You can pull data from balance sheets, tax returns, family financial records, lay them out, and look at some key measures. If the credit line balance, credit card debt, interest expense are creeping up over time, it's a warning sign and a signal to managers that perhaps some changes are needed. Another fact sheet, AgriCon 237, highlights financial ratios and helps with interpretation. So rather than looking only at numbers, you get the stoplight visual signals to look at and emphasize low and high stress situations. AgriCon 790, another fact sheet, provides more detail on how to calculate some financial ratios as well as how to interpret them. I listed earlier budget tools as something that might be helpful in individual benchmarking efforts. On our budget website, we've added what I describe as simple, flat versions of our more detailed budgets. These can be downloaded for free. They are Excel spreadsheets. They can be used either for projections or for summarizing historical data. So again, a record over time that summarizes the relative contributions of different components of the farm, such as cow-calf, wheat, stocker, canola, or hay, can provide insights into profit or perhaps loss centers on the farm, and those can be motivational in making changes that may be needed on the farm. This past year, Kansas State came out with a new benchmarking tool that allows individuals to compare their data to Kansas Farm Management Association data. And Kansas, I'll say Kansas is a much more farming intensive state than Oklahoma. So you can't easily look at wheat stocker operations nor ranch specialties, for instance, for benchmarking. But if you look at the left where I've got the green arrow pointing, you have three choices on benchmark by, and that's dairy, crop acres, and operator age. So in this case, I've selected crop acres, which then gives me the opportunity to specify the size of operation that I want. There's several categories for crop acres. Here I chose 1,000 to 2,000 acres. And you can also specify whether cattle are included in the operation or not. I'm interested in looking at cattle operations, so I chose the largest size category, which here is more than 100 cows. Below that, you'll see that you can enter your farm values. So those would generate the black line that's seen at the chart in the chart at the right. In this case, I haven't overridden what are the default averages for 2016. And so you can see that for this subset of farms within the KFMA database, the 1,000 to 2,000 crop acres with 100 or more cows, the average current ratio is 2.29, a working capital ratio of 54%, debt to asset ratio of almost 22%. So each of these is a ratio that you can look at for your operation relative to KFMA data. So at the right, you'll see charts that represent the distribution of operations within that database. So the blue line is the 10-year, or the blue shaded area is the 10-year KFMA average. And so you can see kind of a bimodal distribution. So there's a number of producers that have 2 or above, which is a good strong signal for a current ratio. A number, more than 40% of the operators have a current ratio that's beyond 4. A notable difference between 2016 and the 10-year average is a shift to the left. So this kind of orange line distribution shows that the leftward distribution shift shows many more operations in the vulnerable zone. So some deterioration in the database is the financial position of the farms within the database. The black line again represents the average. If this were my personal farm's observation, then I'd say that I'd done better than many in 2016, or perhaps not as well as over the 10 years as some other producers. So charts like this are available for other financial ratios, including solvency ratios and repayment ratios. This summer I had the pleasure of participating in the International Farm Management Congress, so I thought I'd share a benchmarking slide from Scotland. FBI is farm business income, and a pound is worth about $1.30. So if we look at the dairy sector, which had the most profitable outcomes in 2016, the average income would be about $75,000. The red bar in all cases is the lowest profitability quartile. The black ones show the average income for the most profitable subgroup of producers, and the blue bar is the average. So you can see they face some of the same issues that we do in the United States. On average, incomes are low, with the least profitable producers earning negative returns, all the red bars. While dairy did okay in 2016, grain crops not nearly so well. And just as in the U.S., there's a lot of variability. So you see a big spread in terms of the difference between the most and the least profitable, and you see some significant differences by different enterprise. So knowing a bit about global benchmarks helps us understand whether we're competitive in global markets, which helps determine our industry's viability long term. Informed decisions start with records, and benchmarks develop from them. More and better information helps with management, particularly of risk, and helps us improve decisions made. Financial stress is increasing, so it's important for everyone to better understand how individual situations are changing over time. Developing measures at regular intervals and in consistent ways is important. Certainly things that happen that are out of a producer's control, and we want to note them for future reference. But consistent evaluation of an individual's track record can be the difference between surviving and thriving. So we've shown that benchmark data are available and can help identify strengths and weaknesses within a business. Again, I'd emphasize that research documents the importance of controlling costs, and so developing that for an individual and comparing it to industry averages can be revealing. Again, if you'd perhaps be interested in learning to use FinBin and contributing to an Oklahoma database, I'd love to hear from you, so please contact me. I wanted to point out that a number of the fact sheets that I mentioned here can be found on the factsheets.okstate.edu website, shown here listed at the bottom. There's an internal Google search. Just type in a word label like financial performance, and it will pull up related fact sheets that may be of interest to you and assist in learning more about the information needed to develop good benchmarks. With that, I'll answer any questions that may have been prompted by the data that I've shown you, or related topics that you might want to discuss. Again, if you have farm management interests, we'd encourage you to find and like our Facebook page with daily posts on topics that are related to farm management. If you have an interest in programming for women in agriculture that's focused on farm and financial management, we invite you to join that site. Check out our Ag Econ Extension website. We have a quarterly finance newsletter that's published there or posted there, but you can also sign up for it. We'd be happy to direct mail it to you. And do check out our e-farm management resources, as we're cataloging a lot of the publications that I mentioned, along with YouTube videos, podcasts, and others on financial management topics that may be useful to you in your work. All right, I'm not seeing questions, so thank you for participating. We look forward to chatting with you perhaps on future webinars. Have a great week.